Let's talk about the article that came out in the Bend Bulletin today. It was on the front of the real estate page, and it said appraisals versus assessments. And there's a difference between an appraisal and an assessment. And I think that one of the things that we all need to know is this is not an exact science. It's a little bit subjective. The appraisal process is a little bit more hands-on, if you will, in that the appraiser actually comes out and does a physical inspection of the property, thereby gets to see some of the the amenities that have been added, the hardwood cabinetry, the stone counters, some of those sort of things that are very, very nice, which the assessment process doesn't really allow for that. And the assessment process is the process that is used to arrive at your taxable value. So let me just kind of explain just a little bit. We do have an appraiser that's lined up. He's going to come in and share with us some of the different things, because there's basically three basic models of arriving at coming up with market value. One obviously is the comparative analysis approach, the cost approach, and the income approach. Now, basically what those mean is the cost approach is one sort of like I lined out a little bit in the last segment, where you take the sum total of the building materials and the labor and the land cost and the fees, and you put that together, and it comes up with what is an actual cost per square foot to replicate a similar property. And that's often used just to give a sort of a baseline. And the other one that's used, quite frankly, is the comparative market analysis. Comparative market analysis it's really, really easy in sort of tract-like developments where there's a lot of similarity. One of the terms I used to love from real estate called homogeneous integrity. But the homogeneous integrity of a neighborhood means that you either had the floor plan A, B, or C, and the garage was either left or right. Well, those properties are really, really easy in a comparative analysis to compare with one another. Some of the other properties that may be a little more dissimilar, may have been built at different times, have different size lots, different finishes. There's sort of a process there where you sort of push and pull on the values to sort of arrive at a value. And the income approach is basically a cash flow analysis. If you're looking at the property, not so much as the structure, that has some value. The replacement cost obviously has some value. If you're going to buy a building that's generating income, you'd like to know how much it would cost to build another one of those buildings. But generally, they use a thing called capitalization rates, which is a relationship between the net operating income and the overall sales price. So, and there's a number of different ways to go through the cost approach. There's gross rent multipliers, there's internal rate of return, there's a number of different ones, and obviously we could take an entire hour just talking about the different approaches, and maybe we'll save that for our appraiser when he comes in. But the bottom line to us today is that it's an opinion of value. It's a snapshot of the value of a property on a given day at a given time. It doesn't factor in that it's in the path of development, that there's some discussion that there may be a zone change in the neighborhood. It doesn't factor in any of that. It's just a snapshot and an opinion of value here and today. And, that's used for a number of different things. It's used for everything from putting your mortgage loans together to estates, to divorces. Unfortunately, there's a number of different times that we need to arrive at some opinion of value, so that hopefully the interested parties can come to some resolution in whatever may be going, or secure the financing that they're looking for at that time. Now, that's all appraisal. Now, on the assessment side is what the tax assessor, in our case, Deschutes County tax assessor, places a value on the property. Now, I know that you've all received a tax statement, and you're about to receive another one here at the beginning of November, and maybe this is a good time to talk about it. But it's basically a window of time that runs from July 1 to July 1. So the time of value that we're talking about is actually July 1 to last July, and the value during that window of time, but you received the statement in November. A little confusing. Not really. I don't think it was designed to be confusing, but that's just how the process works. And then, of course, there's now Also on your tax statement, there's a real market value and there's also an assessed value. And that's sort of a factor of Measure 50, which was voted in by the Oregon legislature in 1997. I guess, when we're going to come back here after the break, I'll be able to talk about that just a little bit, but I think we can squeeze it in here. Basically what happens with that is the assessment sort of runs with trend rates, and it's trending the value of both the land and of the improvement, and it allows it to move forward. They're mandated by the state constitution to have that physical assessment every 6 years, which is generally when a white Deschutes County truck appears across the street and takes a picture of your house. So obviously they don't know if you have hardwood cabinets and granite countertops and all of that. And then the other is the real market value and the assessed value. So whichever is the lower is the multiplier that's going to be used to arrive at your taxes. And if you disagree with that, you have until December 31st to go online with Deschutes County and to go have what they call an equalization hearing, to where you get to present that information. Obviously, a very recent sale and settlement statement is a very, very good way to establish